Hello guys, and welcome back to my channel. Welcome back to Rity Trade Hub. All within this channel is connecting traders to wealth. In this video, I'll be teaching you the 7 keys you need to master to enable you to stay profitable in the forex market and build your profits into millions. Okay, there are several key factors to consider before taking a trade in the forex market, which so many traders don't know about. As a matter of fact, this is the major reasons why 90% traders keep losing in the forex market, and they keep asking themselves, what am I doing wrong? Why are my trades stopped out in loss? So guys, sit back and relax while I review these 7 keys to you. Remember, the last on the list is the most important. And if you have not subscribed to this channel yet, go ahead and hit the subscribe button and turn on post notification bell so that you don't have to miss any of my valuable content. Welcome back guys. The first key to profitable trading is plan your trade and trade your plan. Okay, so this implies that you need to have a strategy in place and stick to it. You also need to have a set of rules that will guide your trading decisions. This include your exit and entry rules, your risk to reward, lot size, and so on. One major thing to consider when planning your trades is risk management. Okay, the goal of risk management is to minimize your potential for losses and maximize your potential gains. Okay, you can always manage your risk by using stop loss orders and be prepared for unexpected market movement. Okay, you need to understand the factors that can affect the market. For example, we have the interest rate changes and economic events that can impact the value of a currency, which can lead to increased risk for you. So guys, always keep an eye on economic and political events that may affect currency values. Be aware of any announcement that can move the market rapidly, such as the NFP, the GDP, the CPI, and so on. I mostly tell my students and mentees to stay off the market during high impact news. So if you're a beginner or you don't have enough experience to enable you trade the news, you can always stay off the market during the high impact news. Okay, remember, risk management is not only about limiting your potential losses, but also about maximizing your potential gains or profit. To achieve this, you will need to set a proper take profit and stop loss levels. This is where your risk to reward comes in. Next to talk about is your position size, which helps you to maximize your risk management, because your position size also determines the amount of risk you're taking in a particular trade. So when you have an idea of your stop loss level, you'll be able to use or set a position size that is appropriate for your risk tolerance and account size. More so, you can use the 2% rule, which states that you should not risk more than 2% of your trading accounts on any single trade. For example, if you have a $10,000 account and want to risk 2%, then you should not risk more than $200 on any single trade. So you should consider the size of your trade in relation to your account balance and risk tolerance. Okay, for me, I love to trade conservatively, but sometimes I risk more than 2%. I can choose to go aggressive, but then that depends on my risk appetite at that moment and the confluences that support my trading decisions at that period. Guys, you don't just go aggressive on every trade because the market is full of uncertainties. Okay, and if you must do that, you should have a separate account for that purpose. You can use a position size calculator on the babypips or investing.com website to determine your lot size. All right, if you want to know more about lot size and how it's calculated, you can check out my video on lot size somewhere around here or here. Okay, the next key on the list is risk to reward. Implementing risk to reward. Okay, risk to reward is a key concept in risk management, and it is used to determine the profitability of your trading strategy. Risk to reward ratio is a measure of your potential loss compared to your potential gain on any given trade. So basically, a high risk to reward ratio means that your potential loss on a trade is much larger than the potential gain. For example, if you set a stop loss at 50 pips and you take profit at 25 pips, the risk to reward ratio is 2:1. That means that for every $2 risk, your potential gain is $1. Okay, and then a low risk to reward ratio means that the potential losses on your trade is much smaller than the potential gain. For example, if you set a stop loss at 25 pips and you take profit at 50 pips, right, the risk to reward ratio is 1:2. This means that for every $1 at risk, your potential gain is $2. For me, generally, my aim is to have a low risk to reward ratio, because with that, I can potentially make a profit even if I am not successful on every trade. So one key factor you need to enable you keep up with good risk to reward is patience. Okay, I see so many traders set up a good risk to reward trades, but they can't be patient enough to allow the trade play out. Probably they feel once they hit the sell button, the trade will just start falling. That's really funny, guys, because it doesn't work that way. And the most funny part is these same traders that are not patient to wait for a trade in profit to hit their profit target or take profit will be the same traders holding a losing position or losing trade for hours with the hope of the trade turning out to profit in their favor. So let's quickly look at patience when it comes to forex trading. Patience is one quality you should possess as a forex trader, okay? Do not rush into a trade. Always wait for the right opportunity. When you are patient in forex trading, it helps you resist the urge to act on impulse and instead wait for the right opportunity to enter a trade, okay? It basically involves setting clear goals, having a well-defined trading plan, and sticking to it. Patience is important because it allows you to avoid making impulsive decisions based on your emotions and instead allow you to make logical, well thought out trades based on market analysis. It can also help you to avoid over trading, which can lead to significant losses, and as well help you hold on to winning trades for longer periods, which can result in bigger profits, okay? Another key factor is mastering technical analysis, okay? I usually recommend the use of technical analysis, charts, and candlestick patterns to analyze the market and to identify potential entry points for my students. Now, the big problem here is that many traders do not know how to technically analyze the chart and when to exit trade, okay? That is why you will hear some traders say, I made 30 pips on this trade, it came back to loss, or it came back to my stop loss. Some even make up to 50 pips, but what happened at the end? They close the trade in loss. Guys, you need to know how to analyze the chart and know when to exit the market. It's not just about the money, okay? You need to master the technical skills to enhance your odds of winning in the forex space. But if you are lost on how to go about that, don't worry. With my mentorship program, you are just a step away from becoming a profitable trader. Besides that, on this channel, I dish out valuable content for my amazing subscribers that will help you profit in the forex space, okay? If you have not subscribed yet, then go ahead, hit the subscribe button and turn on post notification bell. So guys, this brings us to the most important key. I call it the master key because it summarizes every other thing or every other key factor that I've been discussing, and that is your psychology, okay? You know, your trading decisions can be affected by your emotions and psychological state. Now the question is, how does your psychology affect your trade? Some common emotions that can affect your trading decision include fear, greed, and hope. All right. Fear can lead you to avoiding trades that have the potential of large gains. Greed can lead you to overtrading and taking on so much risk in the pursuit of large profits. And hope as well can lead you to holding on to losing positions for too long in the belief that the market will eventually turn in your favor. To properly handle these emotions, you can use techniques such as the risk management, setting your stop losses, and sticking to your trading plan to make less emotional trades. So when applying risk management, you need to be flexible, okay? You need to be able to manage your emotions. You do not need to be overly attached to a trade, all right? Or be stubborn on a position that is not working. This will help you to cut losses quickly and take profit as soon as it becomes available. Well, I do not blame traders who are stubborn on a position that is not working. Probably they are not even aware that their position is not working or may likely not work out. This is because they do not have adequate knowledge of the forex market. But the good news is that I am here, right, to guide you through the process. I am here to guide you through the art of profitable trading. You can sign up for my mentorship program where I hold you by the hand and give you comprehensive guide to enable you to stay profitable in the forex space. Thank you so much for watching. If you got value, hit the like button, subscribe, and share this video so that your friends and family can as well benefit from this life-changing opportunity. See you in my next video.